Good morning, everybody. Hope the week is treating you extremely well. In this week's video, we're going to be taking a look at the four major U.S. indexes, but we are also going to dive into the semiconductors as well as taking a look at biotech and healthcare. And we're also going to take a look at the U.S. dollar as it is doing something very interesting right here as well. We are right in the midst of major earnings week, and a lot of the tech names have reported, and they've actually reported earnings very strong in tech. And in other areas of the market, the earnings have not necessarily been as strong. The NASDAQ here, as the chart that we've got up on the screen, we can see we broke out earlier this week and have continued with those new all-time highs and continued to grind higher. On the flip side, when we jump in to take a look at the S&P 500, we still have not made those new all-time highs. And if we come in here and actually take a look at the Dow Jones is off of its all-time highs, but really ugly action so far today, and that has to do with one of its components. Remember, there's only 30 in the Dow, so it's very heavily weighted towards each individual company. 3M put out earnings, and they're actually laying off 2,000 of their workforce. Their earnings were not good at all. So we continue to see kind of this dichotomy of some areas of the market acting extremely well and other areas of the market acting extremely weak, and nowhere is that more apparent than in the Russell 2000, which is still like 8-9% off of its all-time high and well below its breakdown point, or still below its breakdown point back in October. Right, where the rest of the indexes are pushing up against those all-time highs. So there is certainly some breadth issues in some different areas of this market that still are not strong. And in fact, one of the studies here that came out this week, and this chart is showing us times where the S&P 500 hit a new 52-week high in at least a month, and fewer than 10% of the stocks hit a 52-week high in the S&P 500, and fewer than 75% were above their 10, 50, and 200-day moving averages. Now, when we take a look at this study, we'll see the returns moving forward are pretty even. A week later, 56% of the time it's positive. A month later, 56% of the time it's positive. 2 months later, 56. 3 months later, 56. Right? Essentially, it's the same as essentially random. The market always has kind of that upward bias to it. And if you take a look at the percent chance that the market is positive, moving forward, it's slightly above 50% for pretty much every time frame. So these returns on this study are not showing anything better than essentially average. Risk and reward are lined up with 1% down, 1.5% up. The reason why I'm talking about this is if we were to look at this and look where breadth is stronger, right, it has a much stronger ability to hold on to their gains. So it's not a negative that we don't have the breadth here, but it is certainly not the all-out positive that you would think when you take a look at the NASDAQ and go, man, we're making new all-time highs here. So let's look at some of the other areas that are still showing us very different signs. All right, one, of course, is the semiconductor index. Semiconductor index has broke out a few weeks back. We highlighted it. We talked about it. They continue to run. Right, it's continued to push and make new highs almost every day here for the last couple of weeks, continuing that solid run. Now, semiconductors are a very important area of the market, in my opinion, because it is showing demand from companies to continue to grow infrastructure and their technology internally, right? If the semiconductors are doing well, companies are spending that money to automate, make products better, make their systems better, more efficient, etc. And that's usually a very good thing. And when the semiconductors are doing extremely well and the transports are doing well at the same time, right? I really like when we're in that type of a market environment because remember, what goods the other companies make, the transports ultimately at the end of the day ship them. So if the transports are not giving us the same signal, right, something is lying to us essentially. And the transports had broken up above their major resistance zone from last December, yesterday, and today they're right back below it. And this is the concern that I have moving forward, is that we see some of these essentially false breakouts. We've talked about them a lot in the last couple of weeks, where you have what looks to be that solid move over, and then you just can't hold above that level. For me, the transports need to get and stay over that 11,000 mark. Right? The semiconductors need to continue to hold this. The NASDAQ needs to stay up above its breakout area, and we really need to see the S&P 500 and the Dow finally make that break above, and we need to see the Russell over 1,600. We have all those pieces together. That's going to be a very, very good thing moving forward. Now, when we take a look at biotechs, they have broken down completely. They broke underneath that really important 3350 level, right? We see this breakdown. Put in a potential reversal candle and look where it failed. It failed right up here at that 10-day moving average, and it is back below that zone. We need to get that up over that 3350 level. And if we take a look at the healthcare index, and the ticker for that IXHC, is below it as well, and that is below a 10 and a 20 and a 50 and a 200-day moving average. And again, we look at the biotechs, same thing, right? It is under the 10, the 20, the 50, and the 200-day moving average, all of which are pointing down. That's not a positive signal there for the biotech space. So the point that I'm trying to make from everything here today is we've got some areas of this market that are telling a very rosy story. We've got some earnings in this market that are showing a very rosy story, especially in that tech sector. And then we've got other areas of the market that are not showing us the same signs. And we're fighting at those really important resistance levels. And again, what happens here through the rest of this really important earnings season over the next couple of weeks is really going to determine where we're ultimately going to be in a few months' time. The last thing that I want to talk about here today in this video is the dollar. The dollar has broken out. And let me clear everything off of this drawing so that you guys can see this. What we've got up here, and I'm going to put this in on a weekly time frame for you. We've got 1, 2, 3, 4, 5, 6 years worth of data, and you can see that back to 2017 was the last time we traded over this, 97, 80 level. And it has been a very important zone of resistance. We broke down underneath of it, we back tested, and then we continue to fall. Right, we have that ascending triangle pattern, which we've talked about a number of times, as very bullish because that means buyers are stepping in earlier and earlier. And ultimately, we had a breakout in the U.S. dollar this week. Now, if that holds, that puts the target back up here at this major resistance zone from a couple of years back. And that is that first target. And if we run back up into that resistance zone, that's where the really, really important level comes into play. And we back this out, and I want to look at this on a very large time frame, and I want to talk about the way in which markets move. First off, let's look at this. This is a monthly chart. We got 20 years worth of data on here. Right, the dollar spent a long time essentially trading inside this range right here, from 2007 to 2014. It broke out of this range. And if I duplicate this range and I move it over, watch what happens. All right. Essentially, this range, we go into another range of the exact same size. All right. For the next couple of years. All right. These are big zones, and we get a measured move. And a measured move being markets tend to move from the low to the high of a zone. When it breaks out of that zone, it tends to make a similar size move, which is why when I duplicated the range that we've got, you can see very clearly that that fits perfectly what we have right here. So if you're paying attention to the dollar on a very long time frame, what you are looking for is you're looking for a break above the highs from 3 years back, and then you are looking for it to go into a very similar size range, which, by the way, if we go all the way back and we put our resistance level in, look at where that box puts us at. All right, so a move back up over 105 puts 120 back on track, and a move underneath would put back that 72 zone. So we are still trading in the middle of this range, even though we have a breakout when we look at this on a daily chart. Right, let me remove this guy for you. You can very clearly see that we are basically right at the middle of this range that we've been trading in for the last few years. So while it's a breakout over the last 2 years, on a larger time frame, the move that's happening in the U.S. dollar right now is in the middle of this range that we've been in for the last 5-6 years. So it's not that overly important. The reason why we take a look at the dollar, of course, is because commodities are priced in U.S. dollars. So when the dollar is strong, it typically puts a very big headwind right in front of the commodity prices, and that's why we pay very close attention to it. So the dollar, again, interesting spot for the last couple of years, not a very interesting spot when we back the picture out, and that's why it's really important to take a bigger picture look at things from time to time to get a much better understanding of what actually is going on. And I thought this was a really good opportunity to also talk about measured moves, and you can very clearly see that with the size of those boxes. So I hope you guys found this week's video helpful. As always, I'll see you guys next week. You have yourself a great week. Take care.